The National Association of Realtors maintains historical records dating back to 1981. For 4 decades, the median age of a first-time homebuyer remained between 28 and 33 years old. In June 2025, that number hit 40. That's not a demographic shift, that's a system failure. This represents a full decade of lost wealth accumulation. 10 years of housing equity that will never compound. And it's happening to people at their peak earning years, the 35 to 44 age bracket earning a median of $70,252 annually as of Q2 2025. Peak income, still priced out. The data tells us exactly why. Barrier 1. The price decoupling. Between 2000 and 2025, U.S. home prices increased 197%, rising from a median of $119,730 to $356,000. During that same period, median household income increased 40%, from $70,020 to $97,800. Housing costs grew 5 times faster than wages. In 2022, the median home price reached 5.6 times the median household income. That's the highest ratio recorded since the early 1970s. For comparison, during the 2008 housing bubble peak, home prices were 35% above their historical trend relative to income. Today, they're 50% above trend. We're in a bigger bubble than 2008, and most people don't realize it yet. Barrier 2. The monthly payment trap. The median monthly mortgage payment for recent movers in 2024 reached $2,225. That's up from $1,797 just 3 years earlier in 2021. For context, in 2020, the typical monthly payment was approximately $1,100. It doubled in 4 years. This combines 2 forces. Home prices jumped from $328,150 in 2020 to $418,975 in 2024, and 30-year fixed mortgage rates climbed from pandemic lows to current levels of 6.5 to 7%. For a family earning $80,000 annually, that $2,225 monthly payment consumes nearly half their income. The conventional affordability threshold is 30%. They're at 50% before property taxes, insurance, or maintenance. Barrier 3. The debt burden. The 35 to 49 age bracket carries $634.8 billion in student loan debt as of Q2 2024. That's 40% of all federal student loan debt concentrated in one demographic. Add median consumer debt of $132,280 for millennials, and you have the core problem. Lenders require total debt service, including the mortgage, not to exceed 36% of gross income. The debt-to-income ratio is the gatekeeper. A 40-year-old earning $70,252 with typical student loan payments, auto debt, and credit card obligations hits the DTI ceiling before qualifying for a mortgage large enough to buy a median-priced home. The income is there. The debt service capacity isn't. The 41% down payment. To satisfy DTI requirements in 2025, analysis shows the typical U.S. buyer needs a 41% down payment on a median-priced home, not 20% to avoid private mortgage insurance, 41% just to lower the loan principal enough so the monthly payment fits within the DTI constraint. On a $360,000 home, that's approximately $148,000 in cash. At a 10% annual savings rate with a 5% return, it would take nearly 13 years to accumulate that amount. But home prices don't wait. Between 2020 and 2024, prices increased approximately $90,000. Saving for the down payment is like running on a treadmill that's accelerating. The result? 33% of younger millennials received down payment assistance from family or friends. Home ownership is no longer determined by career success or peak earnings. It's determined by access to inherited wealth. The 40-year-old without family capital faces structural exclusion. The supply crisis. First-time home buyers now represent only 21 to 24% of all home purchases, compared to a historical average of 40%. Where did they go? They're competing against institutional investors, who accounted for 26.8% of home purchases in early 2025, up from 18.5% in 2020. These investors target the low-price tier specifically, the exact segment where first-time home buyers must compete. In June 2024, investors accounted for 29% of purchases in the low-price category. Add to this, all cash purchases represented 33% of all housing sales in the first half of 2025. Cash buyers are immune to interest rate increases. They bypass appraisal contingencies. They offer speed and certainty. A financed buyer making an offer at asking price loses to a cash buyer making an offer 5% below asking price. The 40-year-old with a mortgage pre-approval is structurally disadvantaged before bidding even begins. What gets delayed? Data from 2025 shows that 18% of aspiring homeowners report delaying marriage or having children until they can afford to purchase a home. Similar percentages postpone career changes or starting a business. Housing costs have become the economic choke point for traditional adult milestones. The financial commitment required to clear the home ownership hurdle is so overwhelming that individuals defer everything else: family formation, entrepreneurship, geographic mobility for better opportunities. This isn't a housing crisis. This is a wealth accumulation crisis that cascades into demographics, productivity, and economic growth. Buying a home at 40 instead of 30 compresses the amortization window. Someone who buys at 30 and holds for 30 years owns the home outright by age 60, entering retirement with maximum housing equity. Someone who buys at 40 is still making payments at 60, or holds the property for only 20 years before retirement, accumulating significantly less equity. Since home equity represents the primary wealth reservoir for middle-class families, this delay permanently reduces lifetime wealth accumulation. The gap isn't marginal, it's generational. Why traditional solutions don't work. Some policymakers propose 50-year mortgages to lower monthly payments. On a $360,000 loan, extending the term from 30 to 50 years might save approximately $250 per month, but the total interest paid nearly doubles, potentially reaching $740,000 compared to $328,000 on a 30-year loan. The buyer sacrifices long-term wealth creation for short-term affordability. Equity accumulation slows to a crawl. And without addressing supply constraints, the lower monthly payment simply increases borrowing capacity, which gets absorbed by higher home prices. The subsidy flows to sellers, not buyers. Down payment assistance programs face the same issue. Providing first-generation buyers with $20,000 to $25,000 helps overcome the transaction barrier, but in a market with inelastic supply, the assistance inflates prices by the same amount. The benefit accrues to existing homeowners selling properties, not to the buyers receiving aid. Financial engineering without supply reform doesn't solve affordability. It just redistributes who captures the subsidy. The 40-year-old first-time buyer possesses peak income, career stability, and financial discipline. They're still priced out. That's not a personal failure. That's a structural crisis resulting from wage price decoupling, debt burdens unique to their generation, and supply constraints created by decades of restrictive zoning policy. The delay from age 30 to age 40 represents 10 years of wealth that will never compound. For an entire generation, the primary vehicle of middle-class wealth accumulation has become functionally inaccessible without inherited capital. The math doesn't lie, and the clock is still running. If peak earners at age 40 can't afford entry-level homes without family wealth, What does that mean for everyone earning below the median?